Good morning, James.
Hello, James. How are you?
I'm all right, thank you. Thank you very much for doing this. As I say, so James was on holiday. You remember we thought we had somebody else, and we got sort of let down, and then we booked this last minute. And James was on holiday, so I think he just sort of got landed with it.
Yeah. And if you hear small people running around in the background or that kind of thing, or doorbells, you'll know why.
Yeah, don't worry. Good. So I think, as usual, can we just sort of start off with sort of an introduction to Saints, please?
Yes, happy to. And hello to everyone who's listening and watching today. So Saints. Gosh, there's a lot of text on this slide. I won't bore everyone by reading through it. Let me give you the high level view of what Saints is about for those who don't know, who are not familiar with it. So Saints Scottish American is a trust that's been around for, well, we're coming up for our 150th anniversary this year. There are celebrations going on, so on and so forth. So a very long-standing trust. And at its heart, what it's trying to do, or what it's trying to be for shareholders, is a really sort of solid core shareholding that investors can build a portfolio around. Something that over a long period of time, shareholders can rely on to deliver them really good compounding and capital growth, but also pay out a really resilient and growing dividend along the way. So what we find is that within Saints shareholder base, we've got two sort of different types of investor who it appeals to. One is the sort of classic income and growth investor who's looking for a really good, steady source of income that keeps up with inflation and grows. A bit like James, you referred to that search for income outside of the UK. That's very much Saints' approach. It's a global trust looking for those kind of resilient and growing dividends all over the world. So that's part of the shareholder base, that those folks who are looking for that resilient growing income. But then we've got another part of our shareholder base who, are not really income investors per se, and what they're looking for is just this kind of steady growth, this steady compounding in capital and dividends and good total returns over time. And it really sort of works, I think, quite well for both of them, regardless of whether they are pure income investors or not. And I guess what you can see, we've just had annual results. You can see some of the highlights here on this slide. We've just increased the dividend, or the board has recommended a dividend 9% higher than 2021. That's the 49th straight year of dividend increases. Saints hasn't actually cut its dividends since 1938 was the last time it was cut. So it's been an incredibly secure source of income for shareholders. And you can see that, obviously last year, as we all know, was a more challenging one for income investors, particularly with income keeping up with UK inflation, which obviously has accelerated too. I think the average last year was just over 9%. So, really pleased that the dividend has grown again in line with inflation. In fact, if you look back the past 10 years, you can see that the dividend has actually increased a bit above UK CPI. So delivering real growth as well as a great resilience to that income stream. And yeah, the capital growth has also come through, and that has driven outperformance against global equities over that period of time. So I would argue it's been doing what it says on the tin, giving shareholders a really good compounding of capital growth, good returns, that resilient and growing income as well. And as mentioned earlier, and you see on the last bullet point, this is 150 years now for Saints, and hopefully there's another 150 to come. Probably not with me managing it for the next 150. That would require some kind of, I don't know, I'd need to dip into the International Biotechnology Trust or something to find something to allow that to happen. But hopefully many good years of growth still ahead.
Good, thank you. I mean, that dividend growth thing, I think, is actually quite important. I was casting around, I think I wrote an article on it recently, just looking for ways that you can actually get income growth that at least matches inflation, and most funds are failing to do that. So the fact that you managed to do that is quite impressive. Has that been done without dipping into revenue reserves?
It has, yes. That's a fully covered dividend. And the secret of it really is this isn't immediately obvious if you looked at Saints, but if you look back at the history, the past sort of 20 years, and the trust came across to Baillie Gifford to manage it about 20 years ago. What we've been doing over that period of time is progressively making it a more growth-oriented portfolio, as you probably would expect for a Baillie Gifford fund or Baillie Gifford managed fund. So the secret of it really has been that over a period of time, the names in the portfolio have become a lot growthier. That's been a gradual transition. We haven't done it overnight. It's taken a period of years to allow the, you'll know this, listeners will know this. Typically, when you're going into growthier names, they tend to have lower dividend yields. And so if you want to deliver dividend growth from the trust, you can't do that in a wanna sort of go into much growthier names, because there's a yield hit and a dividend hit. So over a period of time, as managers, we've been moving the portfolio into growthier underlying stocks. And that basically is what you've seen come through in 2022. The underlying holdings have been delivering really good sort of core earnings and dividend growth, and that's what's allowed the dividend to keep pace with inflation in the past year.
Actually, there's a sort of question that alludes to this, they're all coming through already. Talking about how you managed to manage the sort of balance between the defensive, sort of relatively defensive, income producing things that you own, like consumer staples, and trying to get the sort of growth as well. How do you go about doing that?
It comes back to trying always to take the long-term view for shareholders, I think, James. I think it's sort of saying, look, if we look out 10 years from now, what sort of rate of growth do we expect to come through from in earnings and dividends at this particular holding? How resilient is that likely to be if the world economy has a big hiccup at some point over time? And then making sure that within, there isn't a sort of magic number for the balance in the portfolio, but just trying to make sure that that there are names in there that have that incredible resilience, like the consumer staples and some inflation protection, but still a decent bit of growth. Maybe they're growing mid single digits, high single digits, but then combining those with some somewhat growthier names that can deliver double digit type of increases, and maybe they're not quite as resilient, and there's a bit of a question mark about whether they'd keep paying the same level of dividend in a crisis, that kind of thing. But making sure that both are well represented in the portfolio, and taking that long-term view about ultimately ensuring that everything that we own does have a good, solid growth outlook ahead of it on a 5-10 year view.
Cool. Okay. The structure little chart here in the bottom right hand corner. Can you sort of talk about that because it's unusual to have sort of property and bonds and things in a lot of your competing trusts.
Yes. So the logic here is that because we as managers, the board, are trying to deliver for shareholders real growth in income over time, and then the dividend growth as well as the capital growth, the logic is that the vast bulk of the portfolio should be invested in global equities, in companies that have good prospects of doing exactly the same thing. And so that's why you see sort of 98% of NAV currently invested in equities. That's dipped down sometimes 95, 94, something like that. But typically it's getting on 100% of NAV because that matches the real growth objectives of the fund. But then alongside that, making use of the fantastic investment trust structure, obviously the board has the ability to add a prudent bit of borrowing alongside that. And as you can see in that sort of 11% purple bit on the bottom right-hand chart, so there's a little bit of debt in there as well. And then the logic goes, well, why don't we use that, so the board's logic, our logic, use that to invest in things like property, bonds, a little bit of infrastructure in there as well, which hopefully, beats that cost of borrowing. And in fact, the debt obviously is nominal, and often these are real assets like the property and some of the other things that are in there. So use that borrowing ability of the investment trust to generate a little bit of extra income for shareholders, and also hopefully, with real returns that beat the return on that borrowing. So it's not a big part of the capital structure or a big part of what Saints does. The core of it is definitely this one around global equities for real growth. But, that's one of the great things about the investment trust structure. And so the board makes use of that ability to supplement the income and returns there as well. Cool.
To move. There's the chart here showing the dividend history, which is just underscores everything you've
yeah. We like to sort of point out we have crises, obviously, periodically. We just had the COVID crisis, and it's not the first time that Saints has been through a crisis. And I think that the key point here is just a combination of the investment approach, so sort of the bottom-up focus on really resilient dividends from the investments, really resilient income, combined with the benefit of the revenue reserve, allows that fantastically resilient, dependable stream of income through a whole range of different crises that have occurred since the last dividend cut in 1938. In COVID, the trust took a very small amount out of reserves, but actually the underlying income held up extremely well during COVID. So although there was a little bit drawn on revenue reserves in 2020, that again was another year where the board were able to deliver dividend growth.
It's actually quite interesting how well you did with the high inflation period in the 70s as well.
Yes, I can't personally take any credit, but yes, the trust has, and I think so. We've been looking back at the 150 years of the trust, because the 150th anniversary is coming up. One thing that is really striking, and I think probably accounts for that, is that over the years, Saints has proved really quite adaptive to different times. It's had an engaged and interested board throughout its history, who've not sort of done it sort of on the side, but have been really, it's been front of mind of them to say, well, what are we going to do about this? How are we going to keep evolving the trust, and how are we going to keep this relevant to shareholders? That's as true today as it was in the 1970s. So I think what you really see there is the benefit, again, I would say, of an investment trust where you've got a good board who are constantly asking, right, what can we do? How can we evolve? And they've adapted and evolved many times over the years.
Cool. Okay. Right. I'm going the wrong way again. Sorry. So I know this says Belly of Global Economic Growth. That's the open-ended sister fund, is it?
Yes. Well, the team that manages, we manage both open-ended funds and Saints Investment Trust. They're almost identical. Obviously, Saints has the borrowings and so forth, but the name of the team is the Global Income Growth Team. So there are 8 of us in total, and both for our open-ended and for our trust structure, this is what we're all about. We're trying to find these growth companies. We're definitely growth investors to match the aims for shareholders, for unit holders. We're looking for long-term sustainability in everything that we invest in. Because we want to keep that dividend growth and compounding going through thick and thin, and that starts with owning underlying investments with sustainable business models, and we're looking for resilient dividends, again, to match the outcome for shareholders. And if we hold those for long-term compounding, and I think we've got a good track record of showing that we do what we say, we have an average holding period of about 8 years, then you put all those things together and you get the results, or we hope you will continue to get the results that we've been able to deliver, both from the open-ended and from the trust, regardless of whether you're an income or a total return client.
Does everything you hold have to have a dividend?
Yes. Well, the strict rule that we have, to give you the detail, is it either has to pay a dividend, or we have to have high conviction that it's going to start paying a dividend within the next few years. So occasionally, and it has definitely been the exception rather than the rule, we have bought things before they've started paying a dividend. Notably, Apple, back in the sort of 10 years ago, we were pretty convinced it would start paying one, and we bought it before then. That's worked out very well. But by and large, vast majority of cases, it must pay a dividend. I think the difference probably between us and folks listening will recognize this, I think, and know this, us and other income trusts, is that we're prepared to go right down the yield spectrum. And I think you will see this actually on the next slide. I think we've got the portfolio slide in. I don't know if you can click through, James. It might be the next one or the one after. But yeah, there we go. So we're because we're very much long-term oriented, we're prepared to take the long-term view and say, look, even if it's a 0.5% yield or 1.5% yield today, if we see that compounding away and growing really nicely for the next 10 years, we're prepared to invest right down the yield spectrum. But we do want to see a dividend.
Right. Okay. There's a question here around oil, oil and gas, because obviously that's been an area that performed very well last year. It's quite a big source of income for a lot of UK equity income managers. What's your kind of view on that sort of sector?
Well, we don't own anything in the oil and gas space, and we haven't done for a few years now. And our view is essentially that if you take the long-term view, that sort of next 10 years type of approach as we do, it's really quite difficult to see those names growing their dividends in real terms over that period of time. There's a heck of a lot of headwinds against them that to us, it's not impossible, but it makes the odds pretty low. So, in a world that's decarbonizing and demand is likely to be shrinking, and it's not the most supply disciplined industry out there, that seems likely over a period of time to put pressure on prices. Of course, it will be very volatile along the way. We know that, as that's commodity markets, but the long-term trajectory looks a little bit bleak. And at the same time, a lot of these companies know that the writing eventually is on the wall for what they're producing, and so they're trying to pivot their cash flow into other energy projects, which often, frankly, have pretty poor returns. And so you put all that together, and the prospects for long-term good real compounding in earnings and dividends appear to us to be really quite poor. And so they're not fundamentally a fit. We know alongside that, of course, that they don't fit from a resilience point of view. I mean, time and time again, oil companies cut their dividends when there's some kind of a problem, or as we saw in 2020. So there's a fit issue on top of that. But basically, it comes down to that longer term perspective, and we just don't think. Or let's put it another way: we feel that we can do a lot better than taking that bet with the names that you see on this slide here, where we're not having to cross our fingers and hope that somehow they're going to be able to deliver real earnings and dividend growth. I'm a lot more optimistic about the names that you see here.
Okay, good. There's a question here about the holding period. So it's about sort of 8 years. So what drives you to sell something?
It's really that it's failing to deliver the growth and dividend resilience that we thought we were signing up to. I think that's what it normally boils down to. So I'll give you an example. Last year we exited, and this has been a holding for more than a decade, but Hiscox, the UK based insurer. And what we decided was that it just had not and was unlikely to show the dividend resilience that we look for. The nature of its business, insuring catastrophes, meant that when we had huge events like COVID or World Trade Center or whatever it might be, that dividend was unlikely to prove resilient, which is something that we seek for our holdings. And it actually had a pretty good GFC. They kept the dividend and maintained it. And so for a period we thought, oh, actually maybe this is doing exactly what we thought. But then in 2020 they stopped paying a dividend, which was quite unhelpful from a portfolio context. And it made us go back and reassess that and say, is this giving us the growth and dividend resilience that we look for from all of our holdings, or can we do better elsewhere? And we decided the answer was no. It was unlikely to give us that dividend resilience. It disappointed, and so we sold. So that's a practical example of how it tends to be, it just hasn't delivered what we thought, and we've made an analytical error, or maybe the management have changed their philosophy or their strategy. It no longer fits, and so we'll exit.
Okay. Can you explain what you mean by management acceleration? There's a question here, a specific question about Cisco.
So this is one where, you get these companies which the underlying company is very, very high quality, high returns, high moats, high barriers to entry, et cetera, et cetera. But the growth rate is quite, well, let's just say boring. It's not that exciting. They're growing low single digits, if that, in earnings and dividend terms. And these can sometimes, they're quite difficult to sort out, but sometimes they can be really quite interesting investments, because from time to time you'll get a really good new management team who'll come into place in one of these companies, and they'll say, look, we've got such fantastic strengths. Let's stop messing around with thousands of internal meetings and tripping over ourselves. Let's get out there and try harder to grow the company. And when they do that, often that can accelerate the pace of earnings and dividend growth to something that's much more exciting and often isn't discounted in the shares. And so that can fit Saints quite nicely, because often the strength of the underlying business can make it a very resilient dividend payer. But from the real growth perspective, if you get management come in and accelerate growth, then it can fit on the growth side as well. And so one of the names here you see in the 2 to 3% yield column is National Instruments. So that was one where we felt that there was a new CEO, new management team who'd come in to do just that. That's been delivering the past few years. It's accelerated. And in fact, start of this year, they've received a bid from Emerson Electric in the US, recognizing, oh wow, this is actually a really strong business. It just was a bit dull for a period of time. So that's an example of where that's worked out really well for us. But that's what that means, management acceleration label.
Okay, thank you. You got the portfolio there. Did you actually trade around that? I mean, what am I trying to say? Would you sort of top slice and add to things on the weakness constantly as this is going on, or are these sort of stable holdings?
They're pretty stable. Not really. I'm of the view that the main question I think you've got to get right as an investor and as a fund manager is what you own versus what you don't own. That's what you're trying to get right. Are the underlying holdings really good companies with good growth prospects, et cetera, et cetera? That's where most of your value, or at least I think most of the value I add is going to be over time from getting that right. And much less of it, I feel, is going to come from being clever about, I took 30 bips out of such and such and I put it into that one which had a wobble. And I've done, with the aim of an internal team, done some analysis on this over time. And again, this might speak more to me rather than people more broadly, but typically that trading around the edges has not added huge amounts of value. Sometimes you get them right, sometimes you get them wrong. So I try to spend, and as a team, we try to spend the bulk of our time focused on what do we actually own versus what do we not own, and getting those calls right rather than trading it around the edges. Not to say we will never do it. Occasionally, if a holding gets too big, we have, for example, we have a rule that we won't allow anything to go above sort of 5-6% of income and capital. Then we will take some money out from occasionally. So I don't want to say it will never happen, but by and large, we try to avoid tinkering and just let compounding happen naturally and focus on getting the names right. Okay.
So question here is saying that I think you made 3 new investments last year. Is that true?
That's right. Yes. So that was Intuit, the software company, L'Oreal, the cosmetics company, and Cognex, the machine vision company.
And the question is asking if the sort of volatility that we've been having in markets is actually throwing up more opportunities, and would that possibly mean that there'll be more turnover?
It has thrown up a few, and I'd put all 3 of those in that category where they had quite a tumble in 2022, and that was a prompt for us to take an initial holding. But it's a really good question, because one of the things that surprises me is that last year we didn't have more new purchases. We've averaged, if you look back over the past 10 years, we've averaged about 6 new names a year on average, sometimes higher, sometimes lower. So I thought that, with all the volatility, we might have ended up buying a few more. I think what's happened is that a lot of the volatility in markets recently has been in things where I would say they're never going to be a good fit for Saints. They're unprofitable. They are, struggling to develop their business models. They're not paying a dividend. Some of those things have really taken a huge tumble in the past year. But they're fundamentally not what is, core to Saints' objectives. And there's been probably a bit less volatility in the things that we really like and think make fantastic investments over long periods of time. And so while share prices have come back, often for name, we maintain a focus list of names that we really like and we'd like to get into. Often those have come back some way, and in 3 cases we said, hey, look, let's go for this. This looks really attractive. But there's quite a few which have come back a bit, but they're still, in our view, quite richly valued, and they're not sort of strikingly obvious that we want to take holdings. I think that might be. I think that might change in this current year, because there's really quite a large number of names. I'd say an unusually large number of names that we've got sitting on our focus list somewhere, where we're getting really quite close to thinking, okay, let's take the plunge. Let's start a holding in one of these things. So it wouldn't be a surprise to me if we saw more than 3 in the year coming up. But it's a great question. I think that's why so far we haven't bought more of, is just what's proved particularly volatile hasn't really been the stuff that we would want to invest in for Saints. And
do things go in as a 1% holding start off with?
Yes, exactly. That's the philosophy. Start with a 1%. If it's delivering the results that we thought and it's on track, then we'll build that up to a more average size holding, which would be closer to 2. And then after a period of years, if it's really motoring and doing what we expect, then it will get up into that 3-4 sort of range.
We talked about you sort of Saints through different market crises and things. There's a question here saying basically, you've got quite a lot in industrials. Are you worried about potential for recession?
Not particularly, no, because the type of industrial, it's a good observation. We do, and it's correct, we do have a fair amount in industrials. But the type of industrials that we own tends to be at the more resilient end. So first of all, we take care to make sure that the payout ratios aren't too high. So if you own an industrial where in a recession the profits might fall 20-30%, then that's fine if you've got a payout ratio of 40 or 50%, because it's not going to threaten the dividend. So we take care with that to begin with. But also the nature of the businesses that we invest in, they tend to be at the more resilient earnings end. So we're not looking at companies where they might make a loss in a recession or profits down 70%, but much more sort of modest falls, or maybe growth slows to something quite pedestrian. There's a couple of names that are interesting. Some of the larger names that are in there, which are industrial distribution companies, names like Watsco and Fastenal. Those companies are especially interesting because when business slows down, they tend to have big working capital inflows, which so they actually, cash flow at the underlying business actually goes up when business slows down. So short version, but by the nature of what we carefully stock select within the industrial space, I'm not too worried about a recession. I think, that would be a bit of the portfolio that's under a bit of growth pressure, but then that will, over the long term, that will come back again and that will be fine.
There's some very specific questions going on here. I don't know who's asking this.
That's okay.
So what are the key considerations you make when screening for investment? For example, why did you select Watsco over TT or Johnson Controls or TSM over ASML?
Oh, gosh. Well, let me try and give you a condensed version of that.
Okay.
Everything that we look at, we're looking at long-term growth, we're looking at dividend resilience, we're looking at management quality, we're looking at competitive dynamics, how they're likely to play out over the next several years. We're looking at a whole range of factors, and because we're essentially a 60 stock global portfolio, we've got a pretty high bar on what we'll put in. We're not just going to put in any old name. We kind of want it all. We want great growth, we want resilient dividends, great people running it, strong balance sheets. We want the works. And so in any of those comparisons, what has happened is that we have, doing our analysis, there will have been something that will have said, well, this one is stronger than that one. This one we prefer more. This one we can have it all. This one we only get 70 or 80% of it. So in each of those cases, they're not. What I'm saying is they're very much bottom-up investments. So they're not sort of thematically, well, we might as well buy, Johnson Controls rather than this one. We'll take a look at, due diligence of the full range of factors in any individual company, and we'll try to pick what in our view are the best of the best.
That makes sense. You said about themes there. So it's not really thematically driven, the fund, is it? It's driven.
No.
But nevertheless, I mean, within the other Baillie Gifford funds, they have exposure to all sorts of different new exciting themes, emerging industries and things like that. Are there things that you'd like to have exposure to but can't because of the yield?
No, not really, because we go down the yield spectrum. So, for example, if we've got that chart up, let's look in the 0 to 1% yield column. This is sort of slightly extreme, but so anyway. So in Albemarle, we own the world's biggest lithium producer and the one with the best growth prospects in lithium. It's been a fantastic investment for us so far. And I'm excited about, I still think we're early days. We're still at 10% global EV penetration, and that's only going to run up and up and up. We own the world's lowest cost and best producer of the key raw ingredient there. In Intuit, we own a fantastic SME software business, which is benefiting from all kinds of new technologies that it's applying with a huge data lake and massive number of customers that it can learn from to build an SME software platform. In Cognex, we have one of the duopoly and world leaders of machine vision, which for factory automation is a huge growth area. So I'm picking just a few selective examples, but because we go down the yield spectrum, it's not often that it's not like, well, oh gosh, I'd really love to buy that, but there's nothing that pays a dividend. That very rarely happens. I think where you do see companies that don't pay a dividend, they tend to be in areas where the industry just isn't that mature yet, and so the companies haven't got the confidence to pay out a dividend yet. And if that's the case, then they're probably not going to be a good fit for Saint's aims at all. If I think of some, the various cryptocurrency platforms and trading places and so forth, none of those, at least to my knowledge, have paid a dividend. But I haven't sort of been sitting thinking, oh gosh, I wish I could buy, some of the, because they're not at that stage of maturity where they'd be at all fit, a good fit in terms of, really resilient businesses, established business models, high moats. They're still at a very, very formative stage. So typically, because we go down the yield spectrum, we're absolutely able to find those exciting names, and that's a great virtue, I think, of the Saints approach.
When would this fund not perform well? What sort of market would it struggle to keep pace?
I think if it's an all-out hyper-growth market where where everything is on 10 times EV to sales and valuation doesn't matter and it's just about quick buy it before it goes up, in those kind of markets, then good, solid compounders, cash generative, good dividends won't tend to do as well. I would say that would be one. And then I guess a deep value market, or like a serious prolonged deep value market where, again, it's sort of like, hold your nose, close your eyes, cross your fingers on the dividend, and let's hope it goes up. We don't own those things in the portfolio, so again, we'll tend to underperform those. So yeah, a couple sort of extreme environments, I would say. But I guess, James, what I view it is that what we're hoping with Saints is that shareholders, they'll have a basket of different approaches, and they'll have some things that they can invest in if they want that kind of hyper growth exposure, or they want deep value, they can find that. And our hope is that with Saints, you've got something which can be sort of like more the backbone of your portfolio, core holding that you can just kind of go to sleep at night and think, well, it's just going to keep on compounding away with good quality earnings and dividends in the background. So we're fine with that. We don't expect to outperform every year, particularly in extreme market environments. But hopefully our shareholders are okay with that too.
Yeah, exactly. Asset allocation wise, I mean, again, because this is driven by bottom up, but do you look at where the sort of geographic exposures are and things and try and manage those at all?
We do look at them, but they're very much driven bottom up, and the most notable one that we've had for some time now is the US underweight. So in global equity indices, as you'll know, something like 55-60% of the global market is US. And we've run somewhere around the 35, maybe as high as 40% level. There are lots of great companies in the US that fit really well with what we're doing, but we're not kind of benchmark huggers. So we haven't sort of said, well, we better go out and buy some Chevron and get that weighting up to a global index level. It's very much bottom-up approach. So we've looked at that and we're aware of it, and we hope that shareholders are aware of it as well. That so if another one of those challenging markets would be if the US market went on an absolute tear, we are underweight versus global indices, the US, and so that would be a headwind for the portfolio as well. But that one aside, we don't really have any huge over or underweights versus a global index, and we're aware of that one and we're comfortable with that one because we think bottom up it's the right thing to do.
There's a question here about green investing. But actually, let's turn it around slightly. And what's the sort of attitude to ESG, and how do you sort of incorporate that within what we're doing?
Well, we're very what's the right word? We think it's absolutely fundamental to what we're doing because, and God, I've seen this over the years in practice. If you get it wrong, particularly if you've got companies that are harming environment, or they've got social issues, or just poor governance, the odds of you getting that kind of long-term compounding and that resilience that we're seeking for Saint shareholders are pretty low. I mean, I remember. This is going back some years now, but you probably remember this as well. In the mid-2000s, one of the great income stories was supposed to be US coal miners. And, they had decent yields on them, and coal was having a bit of a resurgence. And yes, it was very polluting and unpleasant, but hey, it's a 5% yield and away we go. And those things, they just don't tend to work out very well for long-term compounding, because fundamentally, when there's a problem with the business, governance, environmental, whatever it is, something else will come along that's better, and it will kind of blow the whole thing up. And as you probably know, all the US coal miners, once the shale boom came along and people could get away from all the nasty pollutants in coal, the coal industry went bust within about 5 years, and so much for the dividends. So that's a roundabout way of saying, we take it very, very seriously in our analysis, to the point that not only do we have a full analysis of environmental, social, etc. factors done. Remember, I referred earlier to sustainable business models. We have that done on a sort of ESG basis for everything that we invest in pretty exhaustive detail. But we take that into account with every holding that we have, and we try hard to steer away from any that have those issues. Saint started publishing about 2-3 years ago now an annual stewardship report where we report back on this, and we're doing that not because that's just flavor of the month, but because it is fundamental to the compounding that we're trying to deliver for shareholders. So seriously is how we take it.
Yeah, good. Valuations. The question here is specifically about the valuation gap between the US and other developed markets, and whether you think that's something that you need to factor in. But can you just talk a little bit about how you approach whether you think something's actually appropriately valued or not?
Yeah. Ultimately, I always come back to this, the old Warren Buffett one about investing had been worked out by the time, back in the day of ESOP, that it was all about a bird in the hand and two in the bush. And fundamentally, what you're trying to do as an investor is you're giving up the one in the hand in the hope that you're going to get back two later on. So what we're thinking about with valuation is just sort of saying, given the price that we're being asked to pay today, are we going to get back more than that in the future at a very sort of fundamental level? Now, that's complicated, obviously, because it involves predicting earnings and dividends out for years and years to come, and how that's going to play out. But I would say that we're, valuation aware. We're not obsessed over it because of the complexities of it. And, anyone who, I'm sure, who's listening to this call will know that valuation is an art, not a science. When we're taking an investment, we're thinking, look, if something is growing 15%, 20% a year, and we think that can continue for a very long time to come, there's a huge growth runway, great execution and so forth, great management, that kind of thing, then we'll be prepared to pay up for that. If we think we're going to get more back for that in the future. And similarly, we're really quite wary of, people say, oh, it's cheap. It's like, well, there's a lot of things that are supposed to be cheap, but actually they're on, I don't know, a PE of 8. But you think, well, there's not going to be a business left in 5 years' time. So how is it cheap on a PE of 8? So we're very cognizant of it. We don't have a magic formula for it. We just try to come back to that grounding principle of, why do we think this is worth significantly more than we're being asked to pay for it?
Yeah. And if it's not the right value now, then it goes on that kind of watch list of things. Yeah,
exactly. Yeah. And I guess I'm old enough to know that you almost always get a better chance. There's always that itch as an investor to sort of say, but if I don't buy it now, it will get away from me. But if you're in this for the long haul, then normally something comes along, or a crisis, or some kind of a problem. I had 3 stocks like that last year, high growth companies, which for a variety of, I think, quite short-term noise reasons, had quite a big wobble, and we took advantage of that. So yeah, we'll put them on the focus list, and the time will come, no doubt, when there won't be flavor of the month, and that will be the opportunity for us.
Do you think, as a managing an income fund, that as long as the income's in the bag, it doesn't matter so much what's going on with the short-term noise with the capital?
Yeah, I think there is some truth in that. If the dividend is still growing and that's being delivered by the company, then I think it probably makes you a more patient shareholder. That you're willing to ride out those periods where you say, oh well, it's a recession this year, and Atlas Copco's earnings might be down 10% and so forth. Maybe I'll try. I think there is an element that I think is a nice thing about income investing, that you can be a bit more, or let's say less prone to noise, and more patient and willing to hang on. But obviously we have to balance that with not, I guess we've all seen investments where, that often companies are really reluctant to cut dividends. And so, they can sit there crossing their fingers for a while and say, oh, well, at least I've got the dividend. But you all know that the business is fundamentally deteriorating. So you do have to mind your eye with that approach. But yeah, I do think there's something to it, that it can make you more patient.
Good. And that's been really interesting, I think, James. We've covered an awful lot of ground. Thank you very much for doing this. Yeah,
you're very welcome. I hope it's been interesting to other folks. Reach out to you or to others, and always happy to answer questions. So thanks for inviting me on.
Good. Thank you. All right. Well, I think we'll wrap it up there. We'll be back next week talking to the manager of Ecofin Global Utilities and Infrastructure. And then we've got a sort of a full slate now, I think. I think we've actually just maybe got somebody in for 31st as well. We'll see. So thanks very much for listening in today, and we will be back and see you next Friday. So have a good week in the meantime. Thank you.